What's going on, guys? In this video, we're going to be talking about one of my favorite things to look at, and that is stock repurchase or repurchase of common stock. Pretty much when there's a stock buyback, right? I think you guys understand now. If you clicked on the video, you already know that's what this video is going to be about. But I'm going to explain why I think it is so important, and you should at least look at any stock buybacks or stock selling when you're going to invest in a company. So if you don't know me, I only have a small handful of stocks, 14 to be exact. They're all right here. I do have some Bitcoin, but I only really just started in cryptocurrency. Mainly a Bitcoin maximalist. Yeah, I do have some other coins, but I'm going to be selling those and just strictly Bitcoin. But most of my wealth is wrapped up in stocks, and I probably have a 90-10. 90% stocks, 10% crypto, and I'm probably going to keep it that way for a decent amount of time. But we're going to be looking at Intuit. We're going to be looking at its stock buybacks and why I think it's so important. So when you first start investing, and I was guilty of this, there's only one thing any of us cared about, and that is if the stock had a nice trend like that. If it was like that, great, I'm buying. Then you start to do some research, you become a little bit more educated, and you start to look at maybe the earnings, and then you start to learn about the financial statements. So you'll start to look into that, and you'll learn about income statements, balance sheets, and cash flow. But I'm not saying you need to know all of this. I certainly don't know everything within these financial statements, but there's certain things that I like to look at. Revenue, I think everyone should look at revenue and gross profit. I think those are important. Net income is also very important. Earnings before tax and all of that good stuff is important. But there's certain things that I really don't care too much about, like maybe net interest expense. I really don't know what's good or what's bad on that. But we're going to be talking about not only stock buybacks, but stock issuance as well. So let's just scroll down to it right here. Issuance of common stock and repurchase of common stock. Now, before that, we need to understand market cap, which I think we all know, and outstanding shares. So if we go back to the summary, we can see right here, here's Intuit. Its current price is $536, and its market cap is around $140 billion. So what's its outstanding shares? How do we figure that out? Well, it's pretty simple. Here we go. Here's Intuit. If we take its market cap, which Google Finance is reporting that it's $146 billion, its share price is 536. You take those two, and look, I just did C4 divided by C5, C4 divided by C5, and I got 273 billion shares. So now that we understand outstanding shares, let's look into stock buybacks and stock repurchase. But before that, guys, make sure to check out my channel, subscribe, and like this video if you haven't already. I got over 100 videos of content, all related to the stock market and some related to the cryptocurrency. A lot of really cool Google Sheets videos to look at. So check that out. But let's get right back to this. So we're going to jump over to Seeking Alpha. I know I'm kind of all over the place here, but let's go to financials, and let's go back down to the repurchase, which is going to be in the cash flow statements. So we scroll down. Where is it? Here we go. So issuance of common stock. Let's start there. So what is this? This is the company issuing new stock. So you could see maybe last year, $211 worth of new stocks was $211 million worth of new stocks was issued. This is a good way for the company to raise capital. Then they could take that $200 million and do whatever they want with it. Make a new product, put it into research and development, payroll, whatever it might be. It's a great way to make money. And you may think this is genius. Why don't they just do this? Why do they ever take on debt when they could just issue new stock? Well, because then your shares can become diluted. Now think of the government printing money. Or for all my crypto fans out there, think of a crypto with an unlimited cap. You have Bitcoin only has 21 million Bitcoins, and that's why people love it. Then you have stuff like Ethereum and Dogecoin, and it's unlimited, so that could be a downside. The government keeps printing money, and what's happening to our dollar, it has been devalued over time, 95% over the past 50 years. That's a major problem. And the stock market is no different. If you get a company that's issuing a bunch of stocks, that can dilute all of the shares and it's robbing you of your wealth. But unlike the government, there's actually buybacks, and companies try to buy back more stocks than they sell. So I don't know what happened in 2016 with Intuit, but it was a massive buyback year. But let's just look at the previous year, 2020, $567 million, as opposed to how much were they issuing? Only 211. So they pretty much bought back, and we could see right here. Here we go, 211 and 567. They bought back more than twice the amount of shares than they actually issued in that year. I like to see that, and I like to see that consistently. And we could see right here, 197 bought, 197 sold, 2,000 bought, 200 sold, 900 bought. The bottom part, them buying back, is always greater than the top part, them selling. Why do I want to see that? Because it's a deflationary stock. And pretty much what's happening there is we could just look at a much more simple version. So let's actually get rid of all of this. This is going to be our company XYZ, okay? And let's make numbers really easy. Let's say we have a stock. Yeah, let's say we have a company that's only worth $10,000. Maybe it's a company you start up and your friends want to invest in it. And you have maybe 100 shares. Or, no, I'm sorry. What we want to do is we actually want to flip the share price and the outstanding shares. You'll see why. So shares outstanding and then share price. So let's say you have 100 shares outstanding, okay? So it's not going to be $1. That's just going to be plain text. And then right here, if we take how much is a share? Well, a share is the market cap divided by the shares outstanding. So the share price is $100, right? Now, let's say you're going about business, you figure, hey, we need to raise some money. I need to raise, I don't know, $1,000. So what am I going to do? I'm going to sell another $1,000, right? Sell another 10 shares. So if you do that effectively, look at this. Now it went down to $90. You just cut everyone's wealth in half because you gave out more shares. You printed more shares, essentially. And I know that's not exactly how it works. And if we get into the technical side of it, the market cap could go up and that could fluctuate. But guys, we're going to look at it real basic lens. And this is just more academic viewpoint of it. So I know it's not the real world, but at the end of the day, it kind of acts like that. Similar to Intuit. All of those buybacks, this is where I bought into Intuit. That's my average buy price, $331. And it's not even like it was necessarily a good buy-in. I mean, it was pretty close to an all-time high, as you can see here. And I thought, you know what? It's a good buy. And I bought it in, and it has gone up since my buy-in in less than a year, 61% over 277 days. So that was a pretty good investment. If you can make 60% in less than a year, it's a pretty good investment. Now I get it is the year after the coronavirus and every stock went up like crazy, but these rules still apply for the future, or at least for my rules and what has been working for me for the past 4 years. So let's go back to our little basic example. So Intuit wouldn't be distributing more shares than buying back. So let's say your company is doing really well and you say, you know what? I'm going to buy back some of my shares. So I'm going to now buy 20 shares back, right? So if we have 110 shares outstanding and you, the CEO or the company says, I'm going to buy back 20 of my shares. So you buy back 20 shares. So now that drops it down to 90 shares outstanding. And let's say the market cap just so happens to stay the same. Now everyone's share price went up to $111. So that's what happens. These companies keep buying back more and more of their shares and they're artificially increasing their price. So you may have stakeholders, which aren't shareholders. Stakeholders are people who get affected by the company. So that's maybe the consumers or the employees or the community around the company. They really don't like artificial growth because it's not actually helping the environment, or it's not like the product's getting better or anything like that. But as a shareholder, it does help your bottom line. It increases your wealth in these companies. And it's not like it's overnight, right? It's not like, oh, they just bought back, 5 more shares. Now it's down to 60. Boom, my price just shot up. It doesn't work like that. And with them buying back their stocks, it may go down at first because they actually need to dish out money. They're dishing out their earnings, which could have been paid to a dividend to you, but instead they're buying back their stocks. So maybe that goes down a little bit and you don't really feel it until maybe a couple of months later, or even a couple of quarters or a couple of years later. So it's a delayed effect, but it's an effect nonetheless that helps increase stocks over time. It's not like it's a foolproof thing. If you get a stock that's just a really bad stock, doesn't matter. They can't save it regardless of how much they buy back. But it is a metric that I like to look at, and I hope this video helped explain in a really, really simplistic, dumb way how stock buybacks or stock issuance works. If there's more shares, the share price is going to be less. If there's less shares, the share price is going to be more expensive. So at the end of the day, I want to see companies buying back their own shares. And here's where you could find it. Seeking Alpha, cash flow statement, go down, look at their repurchase of common stock, and look at their issuance of common stock, and look at how they've been doing over the past couple of years. Intuit has been buying back a lot more than it's been actually selling or issuing. So that is artificially increased the stock. That's not the sole reason why the stock has increased. Overall, I think it's a great company, but that is one of many factors that has helped boost up the price to all-time highs. But guys, if you like this video, again, smash that like button. Let me know your thoughts. What do you like to look at for a stock? What other videos do you want to see me do? Drop any recommendations below. And guys, as always, I will see you in the next one.